Hi, everyone. We're going to give everybody a little bit of time to get into the meeting, and then we'll get started. Thank you so much for joining us today. We're really excited about doing Impact Week. We've got a great lineup for you, and I am super excited to start the day off with Kathleen Bilderback. Kathleen is the founding member of Affinity Law Group, which serves the business community. It serves business owners and their executives through the lifespan of their business. She is a graduate from Washington University Law School and also serves as the president of the Society of Financial Service Professionals. So please welcome Kathleen. Remember, if you could put your questions in the chat, that would be awesome. And we will take questions at the very end. Thanks so much. Kathleen?
Thanks, Carla. Thanks for that great introduction. Welcome, everybody. This is business succession planning in a low interest rate environment. As Carla mentioned, I am an attorney, a practicing attorney, and my firm is located in St. Louis, Missouri. We primarily serve business owners at all phases of their life cycle. We have a very robust mergers and acquisitions practice, very robust corporate practice, in addition to other services that business owners need, like estate planning, executive benefits, trust administration. We are lucky enough, we are located in St. Louis, Missouri, but we have clients all over the country. And today's topic is something that's near and dear to my heart because our primary client base is business owners. So I changed my presentation up a little bit based on some things that are going on in the world right now. Today, we're going to start with a discussion of market forces that are impacting year-end succession planning. We're going to talk about some ways that you and your clients can capitalize on the current planning environment. We're going to talk about some tricks and traps tips and traps that we see clients either taking advantage of or falling into as we move toward the end of the year. And I've left a little extra time for questions and answers because I think, now that we're into the fourth quarter, I think people are seeing a lot of transactions actually coming to fruition, or clients trying to get those transactions in the next, 75 days, something like that, before the end of the year. So I want to make sure that your questions get answered. I should tell you, this is going to be a more global presentation. So if you signed up today to see how life insurance can be used to finance a buy-sell agreement, this is probably not the workshop for you. We're going to talk about some more advanced topics. And we're going to start with, as I mentioned, the external forces that are impacting year-end planning. The first one I want to talk about is the potential tax changes for business owners. But before we start that, I think it's important that we review a civics lesson. So if you are of my generation, and I'm not going to tell you what generation that is, on Saturday morning, Schoolhouse Rock taught us all kinds of things. What are conjunctions? Conjunction, junction. What are prepositions? Words and phrases, making them run right. And of course, how a bill becomes a law. Now, the reason I put this in my presentation is almost daily, I get a call from a client or a referral source saying, what are we going to do about these tax law changes? Well, the tax law hasn't changed yet. There's just a proposal. So I wanted to make sure that we reviewed where we were in this process of potential tax changes. If you recall from Schoolhouse Rock, a bill gets introduced. In this case, it was introduced in the House of Representatives. Then it is referred to a committee. In this case, the bill was referred to the Ways and Means Committee. The Ways and Means Committee job is to score the potential tax bill for revenue. How much revenue can this tax bill raise over a 10-year period? So for those of you that have actually seen the House Ways and Means Committee report, you will notice that each individual proposed tax change has its own score about how much revenue it is expected to raise. If you have not seen that report, email me and I would be happy to send you a copy. The report gives about a one paragraph description of the proposed change. We're going to talk about some of those proposed changes in a minute. So that's where we are in this proposed tax change for the end of the year. We have the markup from the House Ways and Means Committee, but there's still a way to go. So that bill still has to be voted on by the House. It has to be referred to the Senate. Generally, it goes to a conference committee where the House and the Senate work together to get some agreed upon version of the bill. Once it's approved by both houses, then it's signed by the president, and only then does our little bill become a law. So we are still in, I would say, the middle stage of getting that tax act through the system to becoming a law. But if you look historically at the last few big tax changes that have been made, many of them have been made in the last 2 weeks of December. And what we are telling our clients right now is, if you wait, there probably won't be time to get everything done before the end of the year. And we'll talk in some detail about specific transactions later on in the presentation and what we're hearing from other advisors on that specific topic. So we're part of the way there. We're trying to proactively plan with our clients who may or may not want to engage in year-end transactions. I do want to spend a little bit of time talking about the tax proposals, and I'm just going to breeze through some of the general ones. It's been my experience that a lot of advisors have been on calls where the topics of conversation tend to be the estate tax, what's potentially going on with grantor trusts, what is potentially going to happen with the limitation of valuation discounts on transactions involving non-business entities like family limited partnerships or family limited liability companies. So I'm not going to go through any of that today. Instead, I'm going to talk about some of the tax proposals which I feel have gotten probably not enough discussion, and the ways that those potential tax proposals will affect closely held business owners. So just a review of the tax proposals generally, and again, many of these also affect our closely held business owners, but you probably already heard a lot about this, so I'm not going to bore you. The top individual tax rate is proposed to go back up to 39.6%. That is the federal rate. Of course, if you live in a state where there's state income tax, the state income tax is tacked onto that. One of the things that's interesting about this particular tax bill, the way in which high net worth individuals or high net worth taxpayers is defined varies from section to section. And I also find it interesting that you can be a single person and make $400,000 worth of income and you are considered a high net worth taxpayer, but married couples, it starts at $450,000. So my husband and Kip and I are both partners in law firms. So which one of us can only make $50,000 before we become a high net worth couple as opposed to two high net worth individuals? Someday, when I have the ability to make laws, I'm going to change that definition. So for this purpose, high net worth individuals, $400,000 individual, 450 couple, also raising the top capital gains rates on those taxpayers to 25%. In addition, there is a proposed surtax on high income individuals. And for this purpose, high income is defined as $5 million worth of income or more. That surtax would be taxed at a rate of 3%. In addition, the bill proposes accelerating the expiration of the higher estate and gift tax exemption. So if you will recall, even if the current law doesn't change, that 11.7 per person exemption that we have right now in 2021 goes back down to $5 million per person indexed for inflation at the end of 2025. So in other words, in January 2026 and beyond, the estate tax exemption will be $5 million per person indexed for inflation. What this bill proposes is accelerating that sunset to the end of this year, making the exemption beginning January 1st, 2022, $5 million per person indexed for inflation. And it looks like with current indexing, that would be a little more than $6 million per taxpayer. So married couples, it would still be $12 million that they could transfer to their heirs without the imposition of federal estate tax. That's individual tax proposals. There is also a proposal to raise the top corporate tax rate, which applies to C corporations, to 26.5%. And that is for C corporations earning more than $5 million. So if you have a client that's a C corporation, they earn less than $5 million, they will still be taxed typically at the 21%, which is the current tax rate. So let's talk about some of these proposals that will impact small business owners that are not getting a lot of discussion. The first one I want to talk about is the expansion of the net investment income tax. So currently, and you will recall sometimes this has been referred to as the Obama tax, the 3.8% net investment income tax is generally applied to passive income of certain high earning taxpayers. And for this purpose, high earning taxpayer was defined as a single person making more than $200,000 a year, or a married couple making more than $250,000 a year. That's our current law. Under the proposal, high net worth earners, that is single people making more than $400,000 a year, or married people making more than $500,000 a year, would pay the net investment income tax on income derived in the ordinary course of business. So in other words, those taxpayers would actually pay net investment income tax on active income rather than just passive income. So what does that mean for your clients? Well, the impact of that proposal, if it's passed, is that S corporation shareholders and partners, including members of limited liability companies, LLCs, taxed as partnerships, with income above the threshold, would pay net investment income tax on their distributive shares. Now, a couple points here are worthy of note. First, that net investment income tax for high earners that would apply under the proposal to active income would not apply to income upon which FICA is paid. So what is the true impact, the practical impact of that? Well, many of you probably have S corporation shareholders, for example, as clients. Historically, S corporation shareholders have tried to take as little salary as the IRS will permit, That is, they have to meet the reasonable compensation rules of the IRS, but they push their salary down, so they pay less FICA and take the rest of the distributions from the company as distributions rather than as salary, because they pay income tax on distributions, but not FICA. Now we're going to be in a situation where, in addition to income tax on those distributions, your S corporation shareholders are also going to pay net investment income tax on that active income if they fall under that high net worth or high income earner definition. There is also a phase-in of this net investment income tax on active income, so it doesn't just come into effect and boom, it applies to every bit of income. So we will have to watch for that phase in. And there is a question about income previously subjected to income tax. So in other words, let's say that that same S corporation shareholder has paid income tax on income, but left it in the corporation, the S corporation, and haven't taken a distribution. There is some question under the current law, if they leave that money in the corporation, will it then become subject to this net investment income tax? I don't think there's a clear answer at this point. So what's a practical result of that? A lot of our S corporation shareholder clients are looking at the retained earnings on the books of their S corporations, and they are making plans to withdraw those retained earnings prior to the end of the year if this bill passes. If the company needs that money for working capital in 2022, we'll be looking at ways to add that money back to the corporation, like shareholder loans or potentially contributions of additional capital to the corporation. So if you have S corporation shareholders, if this net investment income tax would apply to them, if they have retained earnings in their S corporations, make sure that they know that they may have to make some moves at the end of the year in order to avoid future imposition of this tax on their retained earnings. And I'm hoping that people will ask lots of questions at the end. So if you have a question, please put it in the queue. I'll be happy to answer as many questions as I can at the conclusion of the presentation. Next up, the proposed limitation on the Section 199A deduction. This was a very exciting part of the tax code when it passed. It allows many non-corporate taxpayers to deduct up to 20% of their qualified business income. Of course, it doesn't apply to attorneys or a lot of other professional services, but it does apply to a lot of our clients. The proposal would actually cap that Section 199A deduction at $400,000 for a single taxpayer or $500,000 for a married couple without any indexing. So what's the practical impact of that? That means that potentially there's a higher tax on our high income earning owners of sole proprietorships, of partnerships, that includes LLCs, taxed as partnerships, and S corporations. It's also worthy to note, and I don't think that this is being discussed enough, all of these tax changes on high income earning, closely held business owners have a layered impact. In other words, they could be now subject to this cap on their Section 199A deduction. They could also be subject to the 3.8% net investment income tax. They can also be subject to the higher income tax rates that have been proposed, and they can also be subject to the 3% surtax. So all of these proposed tax changes have a layered effect on our closely held business owner clients. Now, again, the proposed effective date of this change is January 1st, 2022. That means that a lot of our business owner clients are running around trying to figure out if there is a way, if this particular act is passed in its current form, are there things that they can do now to take advantage of their Section 199A deductions before they are limited by this new rule? Limitation on excess business losses. Again, this is another one that hasn't gotten a whole lot of discussion, but it's important to a lot of our clients, I think, because of COVID, because some of our clients, their businesses have not survived COVID. So I want to talk a little bit about what this looks like. So historically, business losses could offset other taxpayer income. So if we had a taxpayer with a business loss and they had, let's say, W-2 income, they could offset the W-2 income by their business loss. The Tax Cuts and Jobs Act, which was passed, changed this rule, and it temporarily provided that excess business losses would be carried forward by the taxpayer as a net operating loss. That net operating loss could offset future business income. So if you had a company, you had a business loss in 1 year, you carry that loss forward and offset your business income in a future year. That rule under the Tax Cuts and Jobs Act was set to expire. After the expiration of that rule, business losses would once again be able to offset other income. The proposal is to permanently limit excess business losses. The potential impact of that, and we're going to talk about a change there. It won't be a net operating loss anymore. We'll talk about a change in the way that those losses are calculated. But basically, if this proposal passes, the practical impact is business losses will only be able to offset business income in the future. So we've had a number of clients who are carrying forward business losses with the expectation that they are going to be able to use them in the future. And just a couple specific examples. We did, thankfully, most of our business owner clients made it through COVID unscathed. Perhaps they had business slowdowns, but in general, now that things have opened up again, now that there are ways of dealing with COVID issues, they're on the upswing. We're going to talk about that in a minute too. But we do have some clients that didn't make it through COVID. Restaurant chains, bar chains, some actually clients that owned real estate where the tenants stopped paying rent. They have excess business losses that they have been carrying forward. They may not have those businesses anymore. Those businesses are gone, they're closed. So essentially, if this law passes, they're going to lose the ability to use those business losses in the future. Because maybe now they're working for other companies, they have W-2 income, they will not have business income to use those carried forward losses. Also, it's worthy to note that in the future under this proposal, we won't have a very simple net operating loss that will offset future business income. Instead, there's going to be a change in the way that the limitation is calculated. Basically, a threshold amount will be employed. And in order to have business losses to carry forward, your business losses have to exceed gains from the business plus some threshold amount. And again, that threshold amount is defined based on whether you are a single taxpayer or whether you were a married couple paying taxes. So those are the tax provisions that I specifically wanted to call out during this presentation. I'm hoping that you're going to ask questions. I don't mind answering questions that may, you don't necessarily have to make them hypothetical, just don't provide any identifying information for the client. And remember, if you've heard me speak before, when a lawyer offers to answer questions without charge, that's when you need to take advantage of it. So let's talk about force number 2. Force number 2 is a happier force. Money is cheap and plentiful. As I mentioned at the top of the presentation, Our firm has a very robust mergers and acquisitions practice, and we don't have we're not limited to specific industries. We're not limited geographically. So we're seeing transactions all over the country of all different sizes. And the takeaways from that at the current time are as follows. First of all, there's plenty of cash and it needs to get to work. So private equity deals, we have a lot of our clients who either are private equity, perhaps they've set up their own private equity fund and they're looking to invest in other companies, or maybe the client wishes to expand, they wish to take advantage of some private equity money that's out there in order to fund their expansion, in order to scale up, basically. Normally, private equity deals are pretty complicated. So typically we'll have multiple lenders. We'll have the basic private equity investor. We may have some preferred interest going back to that private equity investor. That may not get the target company all the money that it needs. So we may have another layer of debt on top of that private equity investment, and so on and so on. There may even be a carried interest by the seller or the target company. In this case, we are seeing more and more cash deals. For example, my partner who heads up our mergers and acquisitions practice just finished a $30 million all cash deal on the private equity side. That is almost unheard of. But there is so much cash out there that needs to be invested. It's a great time if your clients are looking at potential private equity investment, either as the investor or as the target for expansion. The money's out there. It's just a question of finding it. Another thing that we're seeing is a lot of activity on the SBA loan side. And we're going to talk about a specific example, actually two specific examples that I have at the end of this presentation. One is a management buyout. One is a family business buyout. Both of them are being financed with SBA loans. For those of you who are not very familiar with the SBA program, the most common loan type that we deal with is referred to as a 7A loan. There, the loan amount can be up to $5 million, and the SBA will guarantee up to 75%. So the way that this works is certain lenders, certain banks, lenders are SBA lenders. They analyze the financials of the company. They determine whether or not they can make a loan on the first $5 million. If it's an SBA 7A loan, the SBA will guarantee 75% of that loan value on behalf of the lender. The SBA loans have a number of advantages. It is a negotiated interest rate, although there are some guidelines, and we'll get to that in a minute. Also, SBA loans frequently can be repaid by the borrower over a significantly longer period of time. For example, if we have a real estate loan, real estate involved in the deal, there's a 25-year repayment plan for that under the SBA 7A loan program. So we're seeing a lot of activity in SBA loans. I will also just point out, I spoke last week at our local Vistage meeting, which is a meeting of CEOs who are members of Vistage. The booth right beside us was one of the SBA lenders in town. They told me very specifically that they still have the ability to get these loans in place prior to the end of the year. If the client has all of their financial information packaged, it can still get through. So my point there is just, there are still SBA lenders out there. If your client wants to do something, they can still get it done by the end of the year using SBA financing. But we're going to talk later about better get a move on, because that's not going to hold out forever. Low interest rates mean more efficient borrowing, and they also mean opportunities for arbitrage. So as always happens, we see this a lot also in the premium financing market, right? We have clients who are doing premium financing now because they can borrow money to pay the premiums on life insurance at a lower rate through certain premium financing programs. And they can then put their money, their cash reserves to work in the business where they're going to get a 12% ROI or a 15% ROI. Same place here in strict business lending. The rates are so low right now. Companies that are creditworthy can borrow and put their working capital to work in other investments where they're going to earn more money. So overall, they're getting advantage of the arbitrage. That's great news for those of you out there who are in the business of investing clients' money, because if they're willing to borrow to finance growth, sales, things like that, acquisitions, you can show them how you can help put that money to work for a potentially higher return. There are plenty of good targets out there. My partners and I talk about COVID fatigue a lot. We're going to talk about COVID fatigue in a minute, so I'm not going to get into it right now. Also, there are very high multiples right now in the marketplace. So in other words, normally when we're looking at the value of a business, we are looking at the business's EBITDA, that is earnings before interest, taxes, depreciation, and amortization. And sometimes we have add backs in order to figure out what the company's real EBITDA is. And we're going to talk about that in a minute. Then the valuation company takes the company's EBITDA and applies a multiple. And those multiples have different breakpoints. For example, for a service business, and I do work with a lot of financial services companies on their own business succession planning. Typically, for the typical financial services business, we're looking at a multiple of 1 to 1.5 times EBITDA. Now those multiples are much higher. And there are other factors that can influence that, including the size of the organization. So if we have an organization where the EBITDA is $10 million or more, they're going to get a kicker on that multiple. But I can tell you, my M&A partner said these are the highest multiples he's seen in his career. And like me, he is not a spring chicken, but I'm not going to tell you how many years we've been in the business. Next up, COVID. This is the third market force which is influencing business sales. So COVID has had some impact, and valuations of companies have become a little less predictable. We see every day clients with supply chain and worker issues. We see every day clients struggling to figure out how they're going to deal with their compliance issues. And for some of our clients who, for example, are government contractors, that is, how do they deal with vaccine mandates? But even for our closely held businesses with no association with the federal government, how do they deal with masking guidelines? How do they deal with quarantine guidelines? Do they follow the local guidelines? Do they follow the CDC guidelines? What should they do? Historically, throughout the pandemic, we've also seen a lot of PPP loan forgiveness issues, especially where companies were in that period of time where they received the PPP money, they spent the PPP money on acceptable uses, they applied for forgiveness, but had not been officially forgiven yet, and yet they're the subject of a transaction. We have in various different transactions figured out somewhat creative ways of addressing that. Frequently, it's addressing it through an escrow. Now that we're seeing more loan forgiveness coming through on a much more systematic and regular basis, PPP loan forgiveness has become less of an issue in a lot of these transactions, but it is still out there. One unfortunate thing that we're seeing in a lot of transactions for our clients who are on the sell side, a lot of the documents that are coming from buyers' firms are trying to allocate COVID risk to the sellers. In other words, they're saying, seller, you have to make a representation that your business hasn't been impacted by COVID. You haven't had any vendor issues or client issues or employee issues. Most of our clients can't make that type of representation or warranty, and my guess is most of yours can't either. So if you're working with a client going through a transaction, make sure if you're an attorney that you're looking very carefully at those documents in terms of where that COVID risk allocation is allocated. You don't want it allocated to your client. Frequently, we just strike the whole thing from any document. So we've talked about taxes. We've talked about the M&A market being super hot right now. We've talked about COVID. I think we also need to talk about who are the clients, and that is Force 4 is the impact of our aging boomer population. Now, depending upon who you ask, the boomer generation was born between 1946 and 1964, which means as we sit today, their average age is 66. If you look at our entrepreneurial clients, the average entrepreneur sells his or her business between age 60 and age 75. And right now, there are great privately owned companies out there that are, it's a target rich environment for anybody who's considering an acquisition or a merger, a bolt-on acquisition where they're adding to the breadth of their company. Excuse me, a vertical, a strategic acquisition where they're buying a competitor. There are great privately owned companies out there. And frankly, these boomers may be just tired and they want to sell at this point. They're tired. They have COVID fatigue, as we mentioned earlier. Frequently, they are first generation sellers. So in other words, they started their business, they built it. I know that we have a lot of clients who don't have a family member or a management team who has either the ability, the financial wherewithal, or the interest in running the business. So we see a lot of first generation sellers out there in this baby boomer community. And this aging boomer population has a huge impact both on the buy side and on the sell side, because even though I say a lot of boomers sell their businesses, a lot of entrepreneurs sell their businesses between 60 and 75, we still have a lot of clients in that age group who are actively acquiring other businesses. So impact of aging boomers is huge in this scenario. So let's talk a little bit about ways in which we see our clients capitalizing on the current environment. And the first example that I want to give is something that I am working on right now, which is a management buyout involving an SBA loan. So here we have Ned. Ned owns a logistics company. The logistics company is based here in Missouri, but it has offices in several other states. This logistics company has a key employee, Rachel. A couple years ago, my client, Ned, decided that it was time to give Rachel an interest in the company. So over time, she earned 20% of the equity in the company through a restricted stock plan. So she is currently the equity owner of 20%, Ned owns 80%. The company is an S corporation. The company has current revenue of about $9.5 million a year. And in 2020, of that 9.5, about 12% dropped to the bottom line as net income. It is a logistics company, so it has very few hard assets. Its greatest assets are, first, its customer list, and second, its goodwill, because it has a great reputation in the logistics community. Interestingly and weirdly, we have several clients who are in the logistics business who do not own any of their own trucks. They do not employ any drivers. They are they employ 1099 employees as their drivers. The drivers typically have their own trucks. So again, very few hard assets, great customer lists, great goodwill. Now, in this particular case, Ned has owned this business for a very long time. He was the sole owner until Rachel became a 20% owner. So she's still clearly in the minority. Both of them are making a very good living off this company. But when we looked at what Ned was taking as compensation, it was significantly higher. In this case, 2 to 2.5 times higher than we would have to pay someone to replace what Ned did as his job. So basically that compensation is added back, as well as his perks. The company was paying things like his car. The company owned his car and paid for all the maintenance and repair. The company paid his country club membership. Even though it's not deductible for tax purposes, the company was Ned's pot of cash, so it was paying those expenses. So when we looked at the true value of the company, all of those owner perks, including the excess compensation, were added back, and that boosted the revenue. There are a couple negatives with regard to Ned's company too. As I mentioned, his customer list is extremely valuable. It's driving the value of the company. However, Ned has a concentration of clients. In other words, he has more than one client, which makes up 10% or more of his business. So it's a couple companies, which are a small cadre and a big piece of his revenue, and then a lot of other clients making up the rest of the revenue. So when we talked to the valuation advisors, of course, that had a negative impact on Ned's company valuation. So where we landed was the company was worth $8 million. And for Ned's 80% stake, that value was $6.4 million. So Ned went to a traditional lender. The traditional lender was backed by the SBA. The lender offered Ned a $5 million loan, and actually did not offer Ned a $5 million loan, offered Rachel a $5 million loan to buy Ned's interest. That loan will be repayable over 10 years at a 6% rate of interest. So Ned will get that piece of his money for his 80% up front, and Rachel will repay that over 10 years. That 6% interest rate is pretty typical of SBA loan rates right now, which are based on prime rate plus a percentage kicker. I believe the percentage kicker on a $5 million loan is currently 2.75% over prime, but don't quote me on that. And I know I'm being recorded. So under the SBA 7A terms, the SBA guaranteed $3.75 million. Rachel had to pledge all of the stock that she was purchasing from Ned in addition to her personal assets. So she had to sign a personal guarantee with the bank in order to get this loan. The SBA and most lenders always want the seller to have some skin in the game. And in this case, Ned took back a seller note for the $1.4 million balance. That note, so it's a seller note, that's going to be subordinated to the SBA loan. And as a matter of fact, it's also going to be on pause, which means that Ned will not get any payments on that $1.4 million note until the SBA is fully paid off. So really, he's on pause for 10 years. During that 10-year period, interest continues to accrue on that loan. Ned is not a spring chicken. I'm not going to say what Ned's age is, but let's just say he's up there. So 10 years to Ned is a big deal. So as part of this whole transaction, concerning ourselves primarily with the seller note, this is what we did. Rachel purchased a term policy with a face amount of $2.5 million. Now, how did we get from a $1.4 million seller note to Ned to a $2.5 million life insurance policy? That's simple. Remember that interest is going to accrue for 10 years. At the 10-year mark, that loan, the principal amount of 1.4 plus the accrued interest would be approximately $2.5 million. So that's how we came up with the face amount in this particular transaction. Rachel owns the policy and she is issuing a collateral assignment in favor of Ned. So remember what that collateral assignment says is if Rachel dies, Ned is made whole. So if they get the policy, Rachel gets hit by a car before the end of the year, Ned has the note for 1.4 million, maybe a little interest in there. Ned would get, basically, he's made whole. So you get the 1.4 million plus the little bit of interest. Any additional life insurance proceeds over and above what Ned is entitled to would pass to Rachel's children, in this case, her adult children, in equal shares. One of the things that I want to point out here is on the way that those seller notes are typically taxed. Typically, Ned is not going to be taxed on any part of the gain on the sale of the stock attributable to the note until the note payments are made. So what does that mean? He's not going to get any money, but he's also not going to get any tax until that note actually starts to be collected. And we're going to talk about why that's important in our next example. So that is our management buyout using SBA funds. So then we have a family business planning transaction. And this is one that I am working on currently, which will close. It will close before the end of the year. So let's talk a little bit about this family and their structure. So here we have Bill and Pam, and Bill and Pam own Reliable Electric, which is an electric company that handles both commercial and residential electric contracting work. Bill and Pam own Reliable Electric 50-50. Now I want to talk about this just as a side note. In this case, Bill is active in the business, Pam is not. It used to be back in the day before the estate tax laws were changed to allow portability. We had to make sure that all of the assets that a couple had were equally divided, so nobody's exemption was wasted if somebody died. We wanted to make sure that we kept their estates relatively equal. With the advent of portability, we don't have to worry about that anymore. And I will tell you that I have found that having a husband and wife where one of those spouses is not active in the business, own the business 50-50 is not a good idea. And here's why. In a lot of states, the assets of husband and wife are protected from the creditors of only one spouse. So for example, Bill owns all the stock. Bill's company does the electric work in a building. The building catches on fire because of faulty electrical work. Bill gets sued, the company gets sued. There's a judgment against Bill. If Pam doesn't own any of the interest in that business and they own their assets together, under a lot of state laws, they get to keep their assets. If, however, Pam owns 50% of that business, that has turned a creditor claim against only one spouse into a creditor claim against both spouses, which can have disastrous effects on asset protection. Also, for any of you who have clients with companies that use union labor, and there is an unfunded pension liability, you do not want both spouses on the hook owning company stock, because then again, the pension would have a claim against the assets that are jointly owned. So no, and yet this is how it was already set up when they came to me. Excuse me. My office is dusty. Reliable Electric is an S corporation. The approximate fair market value is $20 million. This, I think, is the first time where I've had this many kids and they're all active in the business. They have 4 children, all of whom are active in the business. So we don't have to worry here about estate equalization. This case is not about that. So interestingly, this is also a happy family. All of the adult children have worked together. They all have key roles in the company, so there are no slackers. Everyone is really going to work every day. And so Bill and Pam have decided the succession plan should be that the 4 kids should own the business together. I would say that that's unusual, but that's what we have in this specific case. So Bill and Pam already have an ILET, which owns a second to die policy. They are already using their gift tax annual exclusions to shelter transfers to that trust to pay premiums, as well as using their annual exclusions for their kids. That is $15,000 from each of Bill and Pam, $30,000 as a couple, to each of the children every year. So they are using it on a combination of insurance premiums and other gifts to the kids. They don't want to change that. Back in 2012, the last time that we had a big glut of people wanting to do some year-end estate and gift tax planning, they gave each of their children $500,000, which means that currently, and they split those gifts. So $2 million they gave away to their 4 kids. That was considered to be split by the 2 of them. So $1 million off of each of their exemptions. So as we sit today, each of them still has a $10.5 million exemption. The valuation expert that we have talked to, and the valuation isn't complete yet, we're going to talk about that in a minute, has indicated that when Bill and Pam transfer 25% to each child, that will be a minority interest in a closely held business, so it will qualify for discounts. In this case, the certified valuation analyst has suggested that those discounts could be up to 35%, which means that the gift to each child at a 35% discount would be $3.25 million for a total of $13 million. Now, between Bill and Pam, they have over $20 million worth of exemption, so they could easily gift the whole company to their 4 kids with no gift tax consequences and use up a substantial piece of their exemption. But they don't want to do that for 2 reasons. First, Bill and Pam need some money from the business to support their retirement lifestyle. And also, Bill came up the hard way. He earned everything that he got. He actually bought this business from his former boss. He was not a trust fund baby, and he wants his kids to have skin in the game. So he wants them to at least have to purchase some portion of the business. So here's what we've decided as a plan. First, Pam is going to gift her stock to the kids. Remember, in this case, Pam owns 50% of the stock. She is going to gift the stock to the 4 kids. If we anticipate that 35% discount, that means she'll be making over a $1.6 million gift to each child. They are not going to split that gift. Why? Because that means that only Pam's exemption will be used on this gift, which means that if the exemption is reduced at the end of the year, and let's say it's reduced to $6 million, Bill will have some exemption left over, and he'll have more exemption left over, right? Because he's used $1 million, so if the exemption is 6, he'll still have 5 left over. If they split these gifts, he would have less than that. So in this case, Pam is making the gift, they're not splitting the gift. And we figured out the annual exclusion piece of that as well for this year, no gift splitting. Remember that when Pam gifts these shares to the kids, those kids are going to get a carryover basis, meaning that they get her basis in the shares. I can tell you that Bill and Pam have a low basis in the shares, so there's going to be an inherent capital gain in the shares that are gifted to the kids. If you're looking for life insurance sales opportunities, anytime you have a gift and there's an inherent capital gain, remember that the gift means that even if the step up in basis remains in the tax code, those assets have been gifted away. There's no step up when mom or dad dies. So that capital gain is going to have to be paid somehow. Life insurance is a great tool to use for the kids to plan to pay capital gain on the sale of those assets. On the flip side, Bill is going to sell his stock to the kids. And he is selling it, even though each child is getting a minority interest in the company, he is selling his stock on a controlling interest basis with no discounts. He is taking back a 10-year note with interest at the AFR rate. Because the note is for 10 years, we're using the long-term AFR rate. We're not ready to pull the trigger on this transaction yet. It'll be probably December before everything is finalized. But just by way of example, the current long-term capital gain rate is 1.74%. Bill's not trying to make money off the interest here. He just wants to make sure that the kids have skin in the game and that he and Pam have some money. The kids will get a cost basis in the stock that they're purchasing from Bill. So in other words, they're paying, let's say, $2 million a piece. The stock that they buy, they get a $2 million basis. Another thing that I will point out here is we are talking about a 10-year promissory note. So let's say that we key the transaction that the sale is made at the end of the year. So 12/31/2021, Bill sells his stock to the kids and takes back a 10-year promissory note. As I mentioned earlier, under the normal rules of section 453 of the code, there I've been a code quoter, that is the installment sale rules, Bill will recognize tax ratably as he receives those 10 years payments. However, Bill could opt out of the installment method and accelerate all the tax to this year. Why would Bill want to do that? A couple reasons. One is if the capital gains rates go up, Bill will be in that high income earning, Bill and Pam in that high income earning group. So just by accelerating the tax into 2021, he will save 5% on the capital gains tax. So just know that if your clients are planning on selling and there's some promissory note involved in the sale before the end of the year, if the tax rates are scheduled to change after the end of the year, they might be able to accelerate all the tax into this year and pay tax at lower rates. Also, as part of this, we are putting a shareholder restriction agreement in place between the 4 new owners. Basically, the shareholder restriction agreement will cover what happens if one of the 4 kids dies, becomes disabled, has a proceeding like bankruptcy or divorce where the shares are at risk. We will have the common terms, who can buy who out, at what price, what does the closing look like. So all of that is part of what we are doing for the next generation, and that piece of it we will be funding with life insurance. So tips and traps really quickly, because I see Carla on my screen, which means I'm almost out of time. I am out of time. First, timing is everything. When we're talking about transactions like this, sales, gifts, it has to be at the right time for the client for the right reason. And I will also tell you the client has to be emotionally ready. If the client's identity is, I am the CEO of my company that I own, they're probably not ready, regardless of how great the tax benefits can be. If your client is going to have a transaction or hopes to have a transaction between now and the end of the year, they need to start now. On that second transaction with Bill and Pam, we're ready to go, but the valuation company that I talked to 2 weeks ago cannot have the valuation ready until the end of November. So if we hadn't started 2 weeks ago, we might be timed out by the end of the year. So it is important that if clients are thinking about a transaction, they start now. They need to be flexible and they need to be patient. That's not always easy, especially when clients think there's a big pot of gold out there. traps. Clients sometimes have unrealistic expectations. That's always true of valuation. You need to make sure that clients are communicating their expectations clearly to you, to the other side, whether it's a buyer or a seller, because it's important that those expectations be communicated clearly or somebody's going to be disappointed. We've also had a lot of clients where we see them making side deals that are never reduced to writing. That's a bad idea in any scenario. And because I'm a lawyer, I'm going to tell you that's a terrible idea. Also, we see from time to time clients who are engaging in a transaction counting their money before it hits the bank account. They need to keep, if they're a seller, they need to keep selling, they need to keep running their business, because the sale is not complete until the money's in the account. So now, Carla, do I have any time for questions?
You do. We can do a couple quick ones, and I think these are really good. Are 179 deductions still relevant?
Yes.
Okay, that was quick. Can SBA loans be used for funding buy-sell life insurance policies that are at max premium up to the MEC limits?
No. If you're, well, so the purpose of the SBA loan is to purchase an asset, whatever that asset is, or for working capital. I suppose that you could have an SBA loan used for working capital and buy life insurance as part of that. But I think if you're looking for money to buy life insurance, you're better off looking at some of the premium financing providers, because there's a lot of activity out there in the premium financing world.
Very true. And then can you elaborate on the union contractor ownership liability with both spouse owners?
Yes, I can elaborate on it a lot because we had this come up a couple of years ago. So we had a client who owned a small chain of rural grocery stores. And the rural grocery stores employed union workers. And in this case, there were a couple unions involved. And unions, as you know, have their own pensions. And as we all know, frequently those pensions are underfunded, and they have been for a long time. And our client, without any advice from us, this is before they came to us, first of all, the stock was 50-50 in the husband's trust and the wife's trust, even though the husband was the only one active in the business. There was an unfunded pension liability out there. The client, trying to be a nice guy, you know, big box stores would open, they would have groceries, they would take away business from our client's little store. Client would have to close that store. He would move all of his employees to one of his other stores so that they wouldn't lose their jobs. Well, by doing that, he actually just exacerbated his pension liability. So when they finally closed the doors, his piece of the union unfunded pension liability was in the millions. And because he and his wife were both owners of record, we couldn't protect any of their joint assets. Even though Missouri, they were in Missouri, it's a tendency by the entirety state, which means normally any assets that they own as husband and wife are protected from the creditors of just one spouse. Here, the creditor, which was the pension plan of the union, was considered a creditor of both spouses just because of her stock ownership.
Wow.
It was terrible. It was terrible.
And what would the expected time be for kind of going through this process? Valuation, sale, close, 6 months, 12 months, 4 years? What does this take?
Well, it's a great question. As I mentioned, a lot of the valuation firms are getting very backed up because people have started early, which is a good thing. There are some valuation firms that I know that are still accepting new engagements, but some of them are actually cutting them off. And if they haven't cut them off yet, they're cutting them off at the beginning of November. So if evaluation is key to your transaction, that's going to be an important consideration. as I mentioned, the SBA lender next to us said that they can still get SBA loans closed before the end of the year if the client has all of their ducks in a row, they have all of their financial information ready, and can get the package to the lender right away. So if you have if your client has a transaction on the burner, there's still time to get it done. If they haven't even thought about it, no. If they're going to go out to market looking for a buyer, all of that, you know, they may want to hire an investment banker. That ship has sailed, because that takes a much longer amount of runway.
Wonderful. Lots of questions about recordings and slides. All of that will be available afterwards. So thank you so much, Kathleen.
You
Really
are
enjoyed
very
it.
welcome, and I will point out that my email is on my slide. My assistant is off this week because she chose to get married this weekend. So it may take a little while for me to get back to you if you have questions, but I will answer the questions if you want to direct them to me at that email address. And thank you all for joining us today. Have a great Impact Week.
Thank you, Kathleen.